In this video, Mike Wilson from Morgan Stanley analyzes current market conditions, focusing on the Fed rates decisions and the potential for continued volatility over the next 6 to 9 months. He expresses a cautious outlook on growth, indicating that while the labor market is being monitored for weakness that could prompt rate cuts, current conditions have yet to necessitate such actions, suggesting that the S&P 500 could stabilize around 5,500.
And though, Joe, is you get more turmoil in the markets, and the Fed has always been much more focused on credit markets and funding markets. We haven't seen that stress yet in a way that the Fed would worry about. But remember, in 2018, they responded to that too.
You think recent market action has been somewhat constructive in that 5,500 on the S&P held, and that sets up what you're calling a tradable range, which means we could go up enough to make it worth your while to get long?
Yeah, I mean, that's we talk to clients about this every day. That's what they want to know, not what's happening over the next 12 months, but like, how do I make money today? So like our view coming into the year was probably a little out of consensus. We thought the first half would be tougher because expectations were pretty high on the first half. The new administration was very clear that they were going to be, sequencing their policy to be somewhat more growth negative. The tough stuff comes up front. And then the back half is when the better policy starts to flow through. So a tougher first half. I just think people came into the year a little bit complacent that the president was going to do the things he says he's doing, right?
We've been talking about this, not just this morning, but for a couple of weeks at this point. Do you think what's happening with the market is nervousness about what's emanating from the White House and the policy and the tough things they're trying to push through and, concern about whether tariffs are on or off? Or do you think there's something that's really happening with the consumer? We've heard from some retailers. We know consumer confidence numbers have taken a hit. What do you think of those underlying issues?
Yeah, I think those are good questions. I would say another variable I'll bring in a minute. So I think it was expectations versus reality. So as we all know, the market
from a stock valuation
correct
perspective?
Well, not just valuation, but just euphoria around the second half of the year. Let's not forget it wasn't just the election outcome, but it was also the Fed was cutting interest rates.
Yeah.
And the Fed stopped cutting interest rates in December, and valuations were high. So we had to reset sort of this continuation of what had happened over the last 6 months. So that was part of it. The other thing that happened was, yes, the expectations on the growth in the first half were probably too high. The policy is one impact. The other thing that hasn't really been discussed a lot is also this cloud around AI CapEx.
Yeah.
Kind of like that kind of got into the markets at the beginning of the year.
When we heard the earnings that came out from all of the big spenders, they kind of verified that, we're still planning on spending these tens of billions of dollars.
That's right, but there's a deceleration going on. So we had to kind of work off the deceleration. That's why we think 5,500 is a good level, because assuming it doesn't roll over into something much worse, that should hold. So I feel good that there's a tradable rally at 5,500. We got wildly oversold. People's expectations now are kind of in line with reality. And now we have to kind of wait to see how all this stuff kind of plays through into the summer. If growth gets worse, then we could have lower levels. But we've had a lot of price damage over the last 3 months, not just in the S&P. I mean, the S&P is down 10%. Many stocks are down 20, 30, 40%. So the markets, as usual, got ahead of it.
For the year, growth concern and volatility, both likely to persist. What about it? So your worry is growth. You don't think inflation is even with tariffs, that's not the main thing to worry about?
No, that's probably where we were out of consensus with most. Most people thought growth would be too hot and inflation would come back. We're in the other camp, or I'm in the other camp, which is that growth is probably going to be the concern, and we see that in the marketplace, right? Bond and stock correlation again is positive, meaning higher rates are good for stocks, lower rates are bad for stocks. And that was a real change about a month and a half ago. So until that flips again to negative correlation, we think the equity market's focus is on growth.
Growth. So we want to watch something. You're watching, I'm sure, with great interest every single indicator, government indicator, consumer sentiment, all that stuff. On a macro level, when do you think maybe some of the policies that at first got people pretty bullish about animal spirits, I'm talking about deregulation, keeping corporate tax rates low, whatever, got CEOs excited about another Trump administration. When does that take over and offset tariffs, what you call it maybe a slowdown in the government sector because of DOGE? Right. Does it eventually become something that we see M&A, we see animal spirits come back?
And I think that's a second half story.
Second half, that soon?
Probably fourth quarter. And I think this administration has been very clear about this, that they will own the economy in the second half, maybe the fourth quarter. I think they're laying this out. Think about when a CEO comes into a new CEO comes into a company. What do? They restructure the company. They kitchen sink it, and then their plan comes through in the next year. So, the markets will get ahead of this. So I don't think you're going to see a massive pickup in growth and all this stuff that people were excited about this year. It's going to be more of a 26 story. By the way, that's when AI productivity will start to kick into the economy. But the market will start to figure it out in the second half. And if growth gets too weak, once again, I think the Fed will respond, and the market's always like that. So it's going to be rocky, as we said, for at least 6 months, maybe 9 months. And in that process, we'll find things to do, both long and short, for our clients.
And you think some of these policies will bear fruit positively for both the economy and the stock market?
Well, look, Joe, I know you agree on this. It's our best chance, right? So we have to restructure. The government is inefficient, right? And it's too big. And I don't think anybody disagrees with that. So how you do it?
You've been able to tell that I agree with you.
Yeah, well, we've talked about
this. Is it really that clear? I try not to.
So let's do it. Let's go down this path. And they're going to have to be flexible, just like a company would managing their business. We have to, take some costs out. And then the deregulation and lower interest rates and some of the benefits from that can flow through to the private economy later this year into 2026.